start with? Yesterday was a good day.
It's been a good 2 weeks.
It was a good 2 weeks.
It was a good 2 weeks.
What are we doing right now?
We are actively raising money. It's painful. I think a lot of people have been sitting on the sidelines for a while, and the thought of jumping back into it is scaring the shit out of them.
Before we even go on that, before we even talk about the moment, let's just spend some time on capital raising in general. Because it's
Like
never
the process?
easy. Yeah. I mean, as you know, the first time we raised money was 2012 for St. Archer. So that's 12 years now, basically, of raising money. It's never been easy. It seems like it's always hard and it's always a grind. There's moments where maybe it's easier than other moments. But just talk about that process.
I think it depends on time. So like 2 years ago, it was everybody was super greedy, wanting to invest, but they were all buying into the hype of crypto and NFTs and Airbnbs. Right. And the thought of investing in what I would call like a good, sustainable, slow wealth build, but like a good investment just wasn't exciting. And so we were dealing with a lot of people that wanted to invest, but were trying to find the returns in the, 2x in 2 years type of deals. And what was scary at that time, if you remember, was we were talking to people that were getting second mortgages on their houses to buy more crypto or to buy NFTs or any of that stuff. So fast forward to now, you have the polar opposite, right? I mean, how many people do we know that lost a lot in the crypto space?
Those are crappy calls.
And so now they don't have the ability to invest in real estate, number one. Number two, they're trying to find the investment to recoup the loss because they went so heavy on the crypto. And so you almost have this 180-degree swap between what we were dealing with 2 years ago and what we're dealing with now.
What would you, if you had money in crypto, like, some of our friends did, and you watched the value just plummet, would you sell and take the L, or would you just hold and just try to wait it out?
I think it depends on
the coin.
Yeah, that and depends on my situation. But I mean, when things are bottoming out, it's not generally the right time to sell.
Right.
That's the period of time where you actually have to maintain some sort of steadfast discipline,
right,
so that you see your way through the downturn and wait for it potentially to come back up, because you might be down, but you're not out. Right. And if you're not out, well, then you haven't lost.
Yeah, unless you were investing in NFTs. Well, you got suckered and take the L.
And the only people that have to truly sell are the ones that need some sort of capital because they're in a pinch somewhere else.
Right.
But the problem with that is those are the people that shouldn't have gone so heavy to begin with. But good luck trying to tell them that when we were pitching them. I think at that time we were doing Mar Vista. And I think we were doing storage. We had our third opening of storage at the time.
No, you know what? We just closed. We were just finishing up on storage. We were raising money for our Mar Vista project, and then we were gearing up to raise money for our first Ventura project. Right. Yeah. So we had good projects in front of us. Like Mar Vista, Ventura were higher return than we were seeing in that time, and yeah, we had a lot of people say no because of crypto.
Yeah, I mean, just generally trying to pitch a deal where it's a 15%. Net to investor IRR, right? Which is generally our threshold that we try to get to. That's a doubling of your money every 5 years.
Yeah.
That wasn't exciting for people, which was really scary.
Yeah, you know what I actually wasn't prepared for? When we raised money for St. Archer, right? Me and P-Rod, two pro skateboarders, never had really any business experience or beer experience. Josh at the time was an agent and surf filmmaker, no business experience, no beer experience, right? And we raised money for it. Like, we actually were successful in raising money. And after we sold it, we started Commune, I came in with the mentality of raising capital would be so much easier because the last time we did this, everything was stacked against us, right? I was like blown away with how difficult it was to raise capital for real estate. And I say that through the lens of how I look at investment. I'm typically looking at risk and reward, right? Looking at risk, though. And what I notice is most people don't. Most people actually don't really look at risk. They just look at potential return. And when we were selling the St. Archer investment, like we were trying to,
you're hyping.
Yeah,
you're hyping. But it's just not as sexy as, a 12x.
Right.
With St. Archer within, 5 years, even though that wasn't the initial projection. But the the thought process that a lot of people aren't going through is that some money should go there and some money should go here, but they want to go so heavy on the thing that they think is going to make them the most money in the shortest amount of time that they don't realize that they're actually creating quicksand for themselves as an investment strategy. And that was the part a couple of years ago that was super scary. But now, granted, we raised the money, but the amount of conversations we had to do to get there was challenging. And I think a lot of people see capital raising groups in the real estate private equity space like us that make it look like raising money so easy. We raised $2 million this week and $5 million this week and 3 spots left. And it's like, a lot of that's a facade.
A lot of it is.
A lot of it is a facade. And they're not really highlighting all the challenges and the painstaking conversations that are going into it, especially the way that we do it, right? Because we're not selling our deals to institutional investors.
Walk through for those that don't know, what's an institutional investor?
Your institutional investors, your BlackRocks of the world, your big firms that are managing defined benefit plans and pension plans, that they're making the decision on behalf of hundreds or thousands of people. It's a lot easier to sell to those institutions because you're dealing with one investor, not 10,000 investors, right?
And how big is the check size normally?
Significant. I mean, it's at least $1 million, probably closer to. I mean, we've talked to some institutions that have told us they can take down 100 million easy.
Yeah, I would say there's levels, right? Like, some of the conversations we have with high net worth individuals, yeah, it's north of $1 million, right? But when we start getting closer to the conversations we've had with institutional investors, it's like they don't even want to talk to us if they can't get $50 million out the door.
Yeah,
right?
The last one we talked to, they said they told us doing 75 million would be a walk in the park with them. No problem at all. They can get us a check tomorrow if we wanted. And look, on one hand, it's easier for us to do business that way. On the other hand, it's not really the way that we kind of designed our business model. I mean, just the name Commune in and of itself was designed
about us.
to create
it's all
community.
of us together,
yeah.
right?
So it's a lot harder because I'm having to talk to a lot more people because we're dealing with significantly smaller check sizes. But
okay, so when you're talking to people, how many times? What do you think the percentages are of people that say no?
80,
80%.
Well, it's so you have to talk about, okay, the people that are seeing our content that want information, right? So like those people, they hit us up and say, hey, I want to talk. A lot of those people drop off, right? That's like probably 50% of those people never end up making it to the conversation. Of that 50%, once we have the conversation, I'd say at least 70 or so percent at some point in time are either telling me, I'm just not ready, I'm not interested, I think you guys are too conservative, I don't like the structure, the carried interest, meaning the piece that Commune takes out of the deal, they believe to be is too rich. And so we get a lot of no's before we get to the yes. But while that is a part of while that it's a part of the frustration with capital raising, it's actually doing us a favor because it's sifting through problematic investors, right? And you have a bad investor, they could ruin it for everybody.
Right. And you know what I'm going to say too, because 12 years of raising capital, that is how it goes. Like you are going to hear significantly more no's than yeses. So if you are raising money and it feels like people are saying no, or this is something you want to get into, just know that is normal. Don't be discouraged by that. Like, I would say what I hear when I hear no's, a lot of it is timing, right? Like, sometimes just the timing doesn't line up, and it's actually hard to find the time where, what you're investing in fits, the risk reward profile fits, the person has capital available. It's not always easy to do. Then, you're going to find people that just don't fit what you're offering. And that's normal. That's there's good in that, right? To like try to talk somebody in to joining your investment that's not a good fit for them. That's going to create so many more problems down the road, which is what I think you were referring to. Be okay with that.
Yeah, there's also there's an issue. There is a real issue with there being an abundance of information on the real estate side. So if you looked at buying a ETF, do you have any idea what the growth projections are for that ETF over the next 10 to 15 years? You really don't. Yeah. If you buy a stock, if you buy Tesla, as an example, Are you given a projection by Tesla? Are you given a prospectus by Tesla that's going to show what your cash flow or what your growth rate's going to be over the next 10? You're not. And so in the real estate side, we provide a projection. Granted, it is a financial model, it is a target, but we're showing what the expected, return and cash flows would be by holding on to this asset and doing the deal with us. And I think a lot of people get caught up in what's called the paralysis by analysis. They're analyzing and analyzing and analyzing. And so what happens, let's say they're talking to us first, right? And they're seeing this abundance of information. And then they're going out to like the crowdsourcing, CrowdStreet, Fundrise, any of them, right? It's not about those two per se. It's any other group that's offering a real estate deal. And now they're seeing the numbers that would compare to, let's say, ours. Numbers may be the same metric that's being used, but the way they derive at the number that represents that metric is very different. So for example, IRR, which is the internal rate of return on the investment. We may show, hypothetically speaking, a 15% on a deal. Somebody else might show a 19% on a deal. Well, if you don't know how they're arriving at that IRR number, you would very quickly say, why would I do a 15 when I can do a 19? What you're not necessarily seeing is that 19 may be gross to the project, but not net to the investor.
Or even the assumptions that they're making to get that 19. The cap rate might be unrealistic for what that market provides. The rent, the projections can be significantly off. And if you're not somebody who knows how to do due diligence on a specific market or have access to, maybe some of the economists that we use when we're doing our modeling, you're kind of just throwing darts in some regard on like, is this firm actually telling me the truth or not, right? Did you see this Tony Robbins interview
No,
like a week
told
ago?
me a little bit about it. I haven't watched it.
It was fascinating. Like he has a new book coming out called The Holy Grail of Investing, right? I think it's his third kind of trilogy book in his financial three-piece, right? And he interviews, 13 of the largest hedge fund managers, Ray Dalio, one of them. And in it was fascinating listening to him talk about it. He asked Ray Dalio, if you could take like all of the principles to investing that you've learned, like what would be like the core principle that you would live off of as it pertains to investing? And Ray Dalio goes, you know what? I've been trying to answer that question for 30 years, and this is what I've landed on. To have a successful investment portfolio, you need about 8 to 12 investments that are uncorrelated. They don't correlate with one another, right? If you have that, you are basically removing your downside or your risk by 80%, and you continue to participate in the potential upside, right? And he goes on to say, like, look, all of maybe what most people view us, institutional investors as is they're just willing to take big reward. But our focus is never reward. It's risk. We are trying to eliminate risk, right? So then he goes on to talk about how most investments are correlated these days, right? Like if you look at what a financial advisor would typically put a client in, right? It's going to be stocks, bonds, and maybe public REITs, right? But even in those three examples, it's hard to see it uncorrelate now, right? Like 2020, 2008, they all went down together, right? That paired with financial advisors, they only put about 6% of their clients in private offerings, right? And this was kind of the moral of the story. Tony Robbins talks about the holy grail of investing really being private equity, private credit, and private real estate, right? The three, one of those three we do. And he starts breaking down the numbers over time on if you would have invested in the stock market versus private equity, right? And what he was showing was your average annual return. Maybe you can look at IRR. And he basically had the stock market at like 9.2% historically over the last 35 years. And then he had private equity historically over the last 35 years at 14.9. Right? And then he goes through how that looks on your investment. If you invested $1 million 35 years ago in the stock market, your $1 million would turn into I think he had it like 36 million bucks, right? Phenomenal investment. But if you put the $1 million in private equity 35 years ago, that investment would be like 135 million, right? So just the ability for your money to double quicker than the other investment, you're talking about significantly more wealth. But it's just fascinating. You're finally starting to see some of these mainstream figures talk about the value of private equity, private real estate, private credit, The challenge is not everybody gets to participate.
Again, the problem is that people are trying to make these highly sophisticated decisions like your private equity wealth managers, and they're getting so caught up in the analysis. And what's interesting is when I talk to people and they're hung up on one point that they can't get past, and that's causing them to not participate. And look at the deals that we did 4 years ago, like Long Beach is a good example of people that passed on Long Beach. Fast forward to today, where we went full circle with it, sold it, paid out the investors, and those very same people that passed are talking to us now saying, I can't believe I missed out on it. And it's unfortunately because they fell victim to this overanalyzation that caused them not to participate, because to our detriment, again, with real estate, we are giving a lot more content with respect to what to expect or theoretically expect from the investment. And part of me, I kind of go back and forth in that maybe even that level of data, we should be pulling back. The challenge is everybody in our space is doing it. So if we don't do it, I don't know what that puts us in our position, you know?
Yeah, I hear you. I think about that too. Okay, so this week was the last 2 weeks, pretty good 2 weeks for us as far as raising capital goes. Let's talk about some of the real stuff, though. Let's talk about some of the challenges. Right? 'Cause business, what I've learned over the last decade is even when times are good, it's just problem. It's always problems. There's just good problems and bad problems, right? And it just feels like you're constantly having to solve new challenges. What would you say our biggest challenges were in the last couple weeks?
Last couple weeks,
What are we working through right now?
I'd say the last couple weeks, the biggest challenge on my end has been the overwhelming amount of people that have been inquiring about our deals, to the point where I don't have the ability to talk to all of them. So the way that we do business is we don't have like a sales team that actually goes out and contacts these people that are saying, hey, I want to invest with you guys. It was a strategic decision on our part to not, ramp up a massive sales team, which is good and bad. The good is that, and the reason why we did is so that investors can actually talk to me in most cases, being one of the principals of the company, so that they are speaking to a decision maker, right? If I'm going to write a check for $100,000 or $250,000, I want to talk to the guy who's making the calls, not some salesperson who's, making $50,000 a year, who's not going to have answers to most of my questions. So we made that decision that if people are going to write checks, they should talk to a decision maker. Well, shoot, when you're talking about, 800 people opting in on a week, there's only so much bandwidth that we have to be able to do that. And so that was probably the biggest challenge. Right now, I'm sitting on at least 500 people that I have to call back just to schedule time for them to jump in. And so we've kind of in the last week shifted to, no longer doing one-on-one conversations, but doing these kind of like smaller roundtable conversations. Right. But it's been a real challenge for us.
I think I walked into the office the other day, and I walked in the morning, and you just closed the door like 9 a.m, and then you popped out at 5. I was like, bro, what are you doing? He goes, back to back to back to back calls, right?
Exhausting.
7 calls. So,
and it's exhausting too, because I'm saying the same thing 15 times over.
So let's talk about that, because that's an interesting one. Where I totally agree with you, right? Where we ultimately landed on this decision is talking to a decision maker has value, right? Like getting to talk to the principal and the one who actually has a stake in this, and like there's value that you don't get in a lot of other companies or a lot of other investments, but that's limiting, right? You will get to a point where, like, the situation we're in, let's call it as of last week, you're at max capacity, right? So that would mean we're only able to reach out to X amount of investors and bring in X amount of capital, let's call it each week, and then you're stuck there, right? If you can't add a team upon you, your ability to scale is out of the window, right? So what are some of the things that we're trying to do now and still maintain that touch point of, if you want to invest with us, you will get to speak to you or myself or one of us that makes decisions?
Yeah, so instead of trying to get people for one-on-one conversations, because every one-on-one conversation is usually about 30 to 45 minutes, we decided to switch to like a round table. 5 people max, so it's still intimate. Every day of the week on a scheduled time, consistent week in and week out, and basically new investors pick which day they want. So do they want Monday at noon, Wednesday at 3, Friday at 9 a.m.? Pick the one that works for your schedule. Register. There's only going to be up to 5 people along with you, and you'll still speak to a principal. But now I'm getting 5x efficiency by way of speaking to 5 people at once versus doing it one-on-one. And so based on the amount of people that are coming in, at least for now, that 5-to-1 ratio, I think is going to help solve that problem. But I'm not going to lie. There are times where I stop and say, you know what? Maybe we should go the sales team route. Because there's so much more scalability there. I know that if I'm thinking about writing a $100,000 check, I'm not doing it to a 22-year-old entry-level sales. Like, I want to talk to the decision maker. I want to know, what are they thinking? What have they done? What's their values? What's their philosophy? How did they arrive at there's so many things that I want to know, because $100,000 is a lot of money, right? And so to me, I wouldn't want it. And so I'm very reluctant, and perhaps to my own detriment in doing so, I'm very reluctant to staff up a sales team just to be able to solve this problem. I'd rather, put people in a group setting, but still let them talk to a principal.
Okay, so look, you're going from, let's just call it 5-6 calls a day with potential investors every day. And now you're moving over to 1 call a day with 5 potential people on each call, right? So you're now freeing up a lot of time. That's good. But what happens when we get to the point where five people on 1 call is not enough?
Yeah,
it's got to go to 10 or 20 or 30. At that point, do you think it's more beneficial to start bringing on a sales team that it's at least filtering through, let's call it the bad numbers, filtering through the people that just want information, and ultimately almost acting as a soft pitch? This is what we're doing. You can ask some of the questions, and then leading them to maybe the weekly webinar that we do, that you and I are on. Do you think the webinar that we do and the Q&A at the end is enough of a touch point of a potential investor talking to a decision maker? Do you think that will put us in the position where we can actually build out a sales team?
I think it's contingent on the economic cycle that we're in, and how, if people are driven more by fear or if they're driven more by greed. Right now, people are driven by fear. And so they're needing a lot more reassurance. They're needing more conversations. They're needing a lot more questions answered than they would in a period of time where money's flowing and deals are abundant, and it's really just, oh yeah, I got all this money coming in. I'm living in a good economic cycle. I feel way more comfortable writing a check a lot faster. People are scared shitless right now.
Okay, but let me ask you this, because I think it's shifting, personally.
I think it's starting to, but it's a slow ride.
I agree. Yeah. I agree. Let's say though, we stay on this. How much do you think we had committed in the last 2 weeks? Almost a couple $1 million. Yeah, about $2 million. Let's say right now we can maintain this flow this way, right? Say it ramps up, and you start seeing fear move more into greed, which is my expectation, and you see dollars coming in, more leads, and all this. You think that would be the decision to move over to that?
I look at it from a numbers perspective. So if I do 6 pitches a day, one-on-ones, that's 6 people a week. That's 6 people a day. That's 30 people a week. Right now, I'm doing 5 per round, 5 times a day. That's 25 people a week. It ramps up. I have to go to, let's say, 3 a day at 10 people per. That's 30 a day. That's 150 a week.
Right.
So we have room to scale the group structure, because I personally feel like if it's 10 or less, it's still intimate enough. I think once you pass 10, I think you're probably starting to lose that. So I don't know that I'd go past 10, but I feel very comfortable at 10. And even if I had to do it, 3 to 4 times a day, there's some scalability there. Once we get past that, great problem to have.
Right.
Once we get past that, we'll have to solve for it. And I don't have a solution yet, being mindful of talking to an owner versus a salesperson, and also not, draining ourselves out to the point where, we're just exhausted constantly.
Okay, so in this structure, so there's actually, just to give some context, what we're talking about right now is the digital investor. This is an investor who comes in through social media, right?
People we've never met in person, right?
And we've never met in person. This is more new for our business, right? The first 4 years of our business, we were raising capital the old school way, right? It was like lunches and dinners and we'd have an investor invite a handful of friends to a dinner that we'd pitch. Our networks was typically how we were getting capital. And then when did the very first investor come in through social? Do you remember?
No.
Was it 2020?
No, it couldn't have been that late. No, it had to be sooner than that. Wasn't it for Ohio? We had some investors that came in through social.
19?
Probably.
I remember like one came in. It wasn't a lot. It was one. And I remember going, oh my gosh, it's happening. Like I looked at that as such a breakthrough, right? And then like 2020, like we didn't really figure it out. 2021, it was really Mar Vista, it felt like. It felt like Mar Vista and VTA or our first Ventura project is when we really started seeing digital investors come in, right? We have our guy that came in from TikTok, changed the game, right?
I was the one.
Can I tell
I've been thinking about that one for probably the last 45 seconds as you were talking.
I'm gonna tell this story.
Yeah,
so
but make sure you tell it honestly.
I'll include all the information. So basically, I wanted to get to digital capital raises or raising money through social because there was a part of the first 4 years of this business that felt like we were doing it wrong. It was just like, I felt like we were being so current in the presentation and using social media that I was like, why are we raising money the way they raised money in the 90s?
Yeah.
Like, what are we doing?
Yeah, we were 30 years old.
Yeah, it was killing me.
Yeah, but we were also doing like Excel spreadsheets, managing our shareholders through Excel. Everything was archaic.
We were challenged. When the first digital investor came, I was like, oh my gosh, it's going to happen. And once we figure this out, game over, right? And then TikTok hit 2020, right? And I don't know who I heard. I heard Gary Vee or somebody talking about how TikTok's a dance platform for now, but it's going to be huge. It's going to be Instagram, 2 years from now. So I was like, all right, screw it. I'm going all in. Like, entrepreneur, real estate investing content on TikTok.
It was also an ability for you to recreate a brand presence for yourself.
Right.
It's not a skater.
That's right. And I remember Jerry, I think it was Jerry. He was like, what are you doing? TikTok? Like, why are we doing this?
Why are you on this junior high platform?
Yes. Why are you doing this? And then all of a sudden, you and I end up on a Zoom call with a potential investor, right? And, I won't say his name. I was like, hey, where are you from? And how did you find us?
He's from the South.
Right? He's from the South. And he goes, Mikey, I follow you on TikTok, right? And he's older, 65?
Something like that.
65. I follow you on TikTok. You're my favorite financial influencer. I send your content to my kids.
I watch it every night,
right?
15 minutes before I go to bed.
Right. And I'm like, I was just looking at him going, oh my gosh, like it's happening, right? And the amount of dollars he was talking, it was a significant size investment, in context to maybe our traditional Instagram style check. And we finished the call, and then, we continued talking to him for months. And I looked at Michael. I'm like, man, look, that call was flattering, but like, I don't think this guy's going to be an investor.
And I was telling you, he's 100%.
And Michael's like, he's 100% going to be an investor. I'm like, I don't think so. Like, I don't think he's ever going to invest. 14 months later,
and 26 phone calls.
26 phone calls. He ends up becoming an investor, and now he's a phenomenal partner of ours.
He's since re-upped 4 times.
Yeah. So there's the thing you just said that I want to touch on. How many more touch points does it take with a digital investor to get to a commitment than it does us talking to somebody that connected us the old school way in real life?
It depends. So a digital investor, because we just started doing like paid ads, right, through Facebook and Instagram. So a digital investor who only sees the ad, but doesn't necessarily already follow us on social, is very cold. That's a person that requires more hand-holding.
If you were to guess, what do you think without looking at the numbers?
At least 10.
10 touch points.
At least 10 touch points.
Okay.
An or a prospect that sees our ad, is interested, and then actually Googles us, sees our Instagram, sees our TikTok, sees, between you and Commune, there's, a couple million followers there. Then they go through our library. Because people tell me, like, oh, yeah, I saw your ad. I looked you up. I saw your social media handles. I started going through your YouTubes, through your Instagram. I love the content that you're putting out there. I've actually had a few people say to me, I love the fact that a year and a half ago, where Airbnb was the craze, you guys didn't buy into it. And that you guys were saying, be cautious for, A, B, C, and D. So there's those people where it's cold, but then they warm up because they see our credibility.
Yeah, they're building trust through social.
Right. And then there's the ones that are following us.
So hang on. So
those people?
How many touch points for them? Less, of course. 5?
I'd say about 5 to 7.
Okay, what about just diehard followers? People have been riding with us since
I've had
17.
I've had people in the first conversation say I'm in, and then 3 days later the money's in the account.
Right.
But that obviously happens a lot less than the other ones. There's an abundance of people that have less familiarity with us than there are those that are diehard followers of our brand. There's also the people that are diehard followers of our brand who have been following us for years but didn't have the ability to invest with us, and now they finally got to that point where they're able to.
How many touch points do you think it takes for somebody that we're connected with in real life? We have a coffee, lunch, dinner. 3?
Probably. Yeah. There's just something, even though it is the old school way, there is something to be said for the face-to-face interaction in terms of what it does to make you feel better about doing business with somebody. It goes a long way.
Yeah, you can't replicate it yet.
Zoom is just, it's great. It's better than a phone call. It's not the same thing as in person. So our in-person time really is being spent with the people that can write the $1 million+ checks, right? Like, because we still have retail investors that have the capability of writing a 7-figure check. And so we're putting our time and attention there, but we don't want to ignore the $50,000 to $100,000 investor who has never done real estate, wants to get in. And by the way, those are the people that are the most scared about investing, and they require the most handholding. Right. Our $1 million investors are significantly less conversations and having to relay to them what it is that we're doing and why we're doing it. The people that are writing the smaller checks are taking up significantly more time. And so from a public service standpoint, we look at it and say, that's the right thing to do. I'd be lying if I didn't say that internally. Sometimes we're like, shoot, are we doing the wrong thing? Because it is a much longer roadway to actually get to the point where we're making money as a firm. We're doing the deals that we want to do because it's requiring a lot more to bring in the same amount of dollars. And every time we kind of go through this, like we talk about it at least once a year in December where all 4 of us get together for kind of like a 3-day offsite to talk about it. It's a constant conversation. Like, should we be shifting in this direction? And it's a thought that we have. And so far, and I hope that it continues to be this way, every time we've gone down that path, we've always come back to, it's unfair that there's so many people out there that don't have the ability to participate in real estate. Let's do the right thing by making it available for them.
I'm not pulling back, Doug.
Good.
You know me. I'm hell bent on this.
Good.
Okay, so let's. I would say that there's a couple points that we really close on that are good. One, social media, would you say, acts as a phenomenal not only lead source but trust source?
Huge.
So if you're not using it, you got to start using it. Like, you really have to, right? Like I am convinced that there is only a short window of time where you can continue doing business without it. I think as we start seeing the lower end Gen Z and definitely Alpha come into play, when they start building business, social media is part of their life. Like, they are born content creators. I'm watching my kids, 11 years old, trying to create YouTube videos of it's ridiculous, right? You will not be able to compete once they enter the marketplace. So start getting on it now, start using it, so that when they do, you can be competitive. Second, I would say, I feel like our business is in a really good spot. We are doing really well. There's challenges every day. This challenge that we're working through, this is the one this week. There's going to be a new challenge next week. So just know that you are not alone. If you feel like things are going wrong in your business, that's business. That's how it goes. And then I would say, why don't we plan on next week? We'll talk about how the group pitch went. If we think that's going to be a solution, then we'll talk about some new challenges that we're going through. So at least people can start getting an inside look on how our business runs. Yeah. So everybody, thank you for being with us. I hope you enjoyed this episode. We will see you here next week.